Hey everyone. If you look at the fintech industry right now, it looks exactly like the NFL preseason. Think about it. The kickoff just happened, rosters are completely in flux, and every major player out there is trying to figure out exactly what kind of season they're about to have.
And just like in football, half of these companies are making those forgettable little roster moves that literally nobody's going to remember by September. But the other half, they are quietly putting together championship-winning strategies. We're talking massive trades, securing major regulatory approvals, and completely restructuring their playbooks to dominate the field.
Okay, let's dive into this. Here's our starting lineup for today's explainer. First, Stripe stacks its roster with mega deals. Second, World Liberty Financial secures a massive regulatory franchise tag. And third, Gemini fights through a seriously painful rebuilding year. Let's get into it. All right, kicking things off with Section 1, Stripe stacks the roster.
If the fintech world had a general manager who was just ruthlessly, aggressively hunting for a star quarterback, it would absolutely be Stripe. Over the weekend, they closed their acquisition of the AI routing startup OpenRouter. The price tag? More than $7 billion. Now that number is actually down a bit from the $10 billion price that was initially floated last month. But make no mistake, this is a massive bet. Especially when you realize OpenRouter was founded just last year in 2023 and was valued at only $1.3 billion as recently as this spring. So, what did they actually buy for all that cash? A single API that routes requests across more than 400 AI models from over 60 providers. Basically, it just automatically decides which AI model should handle a specific job.
And this brilliantly illustrates Stripe's larger strategy when you look at the whole board. You see, this isn't even their first AI purchase this year. Back in January, they bought a billing platform called Metronome. Put these two pieces together, and Stripe now owns both ends of the AI cost equation. OpenRouter decides which AI model is best to answer a request, and Metronome figures out exactly what that request should cost and how to bill the customer for it. They're essentially building the ultimate toll booth for the AI highway.
But Stripe definitely hasn't stopped there. They are still trying to pull off the biggest trade in the league. Reports are showing that Stripe, along with private equity firm Advent International, are back at the negotiating table with PayPal. Remember, back in July, PayPal's board straight up rejected their initial bid. And that bid was a staggering $53 billion, or $60.50 a share, which PayPal just brushed off as being way too cheap. Now we're hearing a revised deal could land within weeks.
Since that initial bid leaked in mid-July, PayPal's stock has climbed more than 30%. That momentum sends a really clear signal. The market firmly expects Stripe to come back with a higher number. Stripe is out here building its own internal AI depth chart while simultaneously trying to buy up what they clearly view as the league's most undervalued franchise.
Okay, moving right along to Section 2, World Liberty's franchise tag.
Now for a very different kind of strategy. If Stripe is playing the acquisition game, World Liberty Financial just secured the ultimate regulatory franchise tag. The Office of the Comptroller of the Currency, the OCC, just granted the Trump-backed World Liberty Financial a conditional approval to charter a national trust bank. Guys, this is a massive shift. Their stablecoin, USD1, which has north of $4 billion in circulation, was previously managed in a partnership with crypto custody firm BitGo. This new charter effectively rips that $4 billion out of that partnership and puts direct control of the stablecoin strictly under federal banking supervision, operating as the brand new World Liberty Trust Company.
But look, this isn't a total free pass. It is strictly conditional. They have some major structural hurdles they have to clear first before they can fully hit the field. For starters, they need a minimum of $20 million in capital. Out of that, at least $10 million has to be held in liquid assets. Plus, they are strictly required to have an internal audit manager on staff. The framing from their leadership here is absolutely crucial to understand. Chairman Zach Witkoff stated they will now be, quote, examined on the same standards that have governed banks for generations. And they've honestly stacked their board to match this new traditional banking reality. We're talking veterans like Zach Witkoff, Scott Alper from Witkoff Group, Robert Witkoff, the former co-CIO of Chubb, and independent directors like ex-Markham CEO Jeffrey Weiner. They are sending a strong signal to regulators that there are adults in the room who truly understand legacy financial compliance.
And the timing of this approval, it's literally impossible to ignore. This landed on the exact same day that a separate 90-day federal review came due. Back in May, a review was ordered to identify regulatory barriers that were slowing down fintech bank partnerships across 6 different agencies, including the OCC, CFPB, and SEC. Getting a charter like this has been the fintech industry's biggest structural fight all year long. It usually takes companies years of intense lobbying. So this approval is the loudest signal yet of exactly how the regulatory winds are shifting right now.
Finally, let's jump into Section 3, Gemini's rebuilding year.
Sometimes the team just has to endure a whole lot of pain today to build the foundation for tomorrow. For Gemini, the sheer paradox of their second quarter numbers perfectly illustrates a classic painful rebuilding year. Just look at the top line for a second. Revenue actually jumped an impressive 37% year over year, hitting $45.5 million. Great, right? Well, look at the bottom line. That growth was completely eclipsed by a staggering $107.7 million net loss for the quarter.
So what on earth caused a massive hit like that? Well, a lot of it traces back to a $16.1 million credit loss provision tied to an identity fraud incident that got flagged earlier this year. Because of this one incident, transaction losses absolutely blew up, skyrocketing from $3.6 million last year all the way to $20.1 million this quarter. As a result, shares fell roughly 7% on Friday.
But we can't just stare at the losses here. We have to look at what they're actually building underneath the surface. This quarter proves the Winklevoss twins' diversification strategy is in full effect. We're basically looking at two completely different businesses. On one side, the core exchange revenue, which is still Gemini's largest single line, fell by 38% because crypto trading volume plummeted from $11.3 billion down to just $3.8 billion. Ouch. But on the flip side, credit card revenue jumped 231% and staking grew by 50%.
Furthermore, they are aggressively trimming the fat. Operating expenses dropped 15% sequentially. They managed this on the back of a February headcount cut, alongside completely exiting the UK, EU, and Australian markets. What you're seeing here is hard proof that Gemini is actively building a diversified business that does not need volatile crypto trading to survive. They are just still paying the very heavy bill for getting there.
Which brings us to the end of our explainer today and leaves us with one incredibly important question. We just saw three drastically different approaches to the fintech preseason. Stripe is out there aggressively stacking its roster and chasing mega acquisitions. World Liberty just snagged the regulatory access that literally every fintech desires. And Gemini? They're enduring heavy losses to fundamentally rebuild and diversify their core business. With these divergent strategies in play, who's actually going to win the fintech championship when the regular season begins? Take a look at these moves, run the numbers for yourself, and think about who is truly building for the long haul. Thanks for joining me on this explainer, and definitely keep your eyes on the board.